Good morning, and welcome to our webcast. Today's session, Unlocking Term CORRA, Methodology, Use Cases, Licensing, and More, is the 6th episode of the CDOR Transition webcast series hosted by the TMX and the Canadian Alternative Reference Rate Working Group, CARR for short. If you have missed any of the first 5 episodes, you can find them on the TMX website, and I have them listed here. My name is Louise Brinkmann, and I am Head of Benchmark Solutions at CanDeal. I'm the Benchmark Administrator for Term CORRA and today's moderator. I'm joined by Jacqueline Green, Managing Director and Head of Financial Markets for Corporate Banking at CIBC. Jacqueline is also the co-lead for CARR's Term CORRA subgroup. We also have Gavin Morris with us today. He is the Director of Datalinx Business Operations at the TMX. Today's goal is to provide you with useful information on Term CORRA, how it came to be, the calculation methodology, and some of its features and benefits. Jacqueline will discuss use cases and practical banking applications in the real world, the practitioner's view. Finally, Gavin will let you know about the licensing and distribution process so you can access Term CORRA and unlock its value for your organization. While CDOR has served the Canadian dollar market well for many years, there are certain aspects of its architecture that pose a risk to its future robustness. To address this, the Bank of Canada and the CARR Committee have been working on solutions tailored for Canada since 2018. The first product of this collaboration was the creation of Overnight CORRA to replace CDOR. Following this, in 2022, CARR consulted with stakeholders on the usefulness of a forward-looking benchmark to complement the Overnight CORRA rate. Feedback was very positive, and a decision was taken in October 2022 to begin development of 1- and 3-month rates, Term CORRA. In January of this year, CanDeal was announced as the benchmark administrator for Term CORRA, and work began in earnest to complete the technology and infrastructure build, hire a benchmark administrator, make a 2-part application to the securities regulators under Multilateral Instrument 25102. The first one was for CanDeal to receive recognition as a designated benchmark administrator, and the second was for recognition of Term CORRA as a designated interest rate benchmark. In July, Term CORRA was beta launched, and TMX began publishing Term CORRA each business day, followed by the official production launch and regulatory approvals in September. Now, you've been following along, and I'm sure you're all aware of 2 other important dates. November 1st, 2023, earlier this month, the stop sell date, no new loans that reference CDOR or BAs. And June 28, 2024, roughly 7 months from now, when CDOR will cease entirely. Industry should take comfort in the fact that Term CORRA is regulated, and the control framework includes the Benchmark's Board of Directors, as well as a special dedicated oversight committee and stringent regulatory reporting requirements. CARR and the Canadian securities regulators ensured from the very beginning that Term CORRA would be aligned with IOSCO principles for financial benchmarks, layering on global benchmark best practices in the development of the Canadian regulations. There are 3 important roles in the daily production of Term CORRA. It really is a partnership. We have CanDeal Benchmark Solutions as the administrator, with overall responsibility for Term CORRA, including oversight, monitoring, and regulatory reporting functions. And then we have TMX Datalinx providing the input data, as well as licensing, distribution, and the client-facing element. Finally, we have CanDeal Data and Analytics acting as the calculation agent. In addition, it should be mentioned that every step of the way, the Bank of Canada and the CORRA Working Group have been there to provide guidance and advice. Let's look at the methodology. It was set out by CAR in a paper published in January of this year. It is based on the Highfield and Park methodology developed by the New York Federal Reserve for term SOFR. It uses a waterfall approach with a level 1 calculation using observed trading data and a level 2 calculation using historical data points should there be a lack of observable data. Sorry about that. Since we began calculating term CORRA in April, we've produced both the level 1 and the level 2 rates each business day, but we have always had sufficient trading observations to publish the level 1 rate. Input data for term CORRA is generated by sampling trading activity and committed quotes in the 1-month and 3-month CORRA futures on the MX. The sampling takes place in 10-minute intervals over 2 hours between 10 a.m. and 12 p.m. each business day. Trades and committed quotes are included in the data for each interval, from which a volume-weighted mid-price is calculated for each contract. The final price used for each futures contract represents a median value across all the intervals. These future prices are used to determine the future path of CORRA, the one that's most consistent with these prices, assuming that CORRA only changes on Bank of Canada interest rate announcement dates. This CORRA forecast is then used to calculate 1-month and 3-month term CORRA as the forward-looking CORRA average over the coming 1 and 3 months. For the math lovers in the audience, if you want a more detailed dive into the methodology, you can find it on the CanDeal Benchmark Solutions website. In terms of benefits, term CORRA is evidence-based and relies on observable inputs rather than the CDOR model that relies on subject matter expertise. Term CORRA is transparent in its calculation methodology, and it's regulated. Term CORRA provides payment certainty so that all parties will know the final amount of interest at the start of the transaction, allowing better ability to manage cash flow and liquidity. Term CORRA rates are risk-free and do not include a bank's funding costs or credit spreads. If you look at CDOR rates alongside overnight CORRA or term CORRA, you will see that term CORRA rates are lower for this reason. Term CORRA also has a uniquely Canadian feature called a rate flip mechanism. Jacqueline will tell us more about this feature. And so now I will turn it over to Jacqueline to take you through the use cases and the practical application of term CORRA.
Thank you very much, Louise. In August of this year, CAR published the recommended use cases for term CORRA, and those are available for review on CAR's website. To summarize, the use cases are limited to business loans, single currency derivatives hedging business loans for lenders, borrowers, or guarantors, cross-currency derivatives hedging business loans for borrowers, and lastly, interdealer trading of basis swaps between CORRA and term CORRA. What's not included are consumer loans or mortgages, floating rate notes, securitizations, capital securities, structured notes, derivatives that don't fall into the categories that I mentioned earlier under the permitted cases, and lastly, deposits. Just to provide some additional background on the use cases, the goal of CAR was to limit term CORRA's use to only those products that truly need it. And this was determined through the creation of a working group comprised of representatives from across the industry, both banks and corporates, as well as through a public consultation process, as Louise noted earlier. That public consultation primarily identified the business loan market as the area with the greatest need for a forward-looking term rate to help manage the operational complexity and to help borrowers provide cash flow certainty. Ultimately, it's very important to remember that the goal of transitioning to risk-free rates is to move to rates that are based on robust, readily observable transactions. Given that term CORRA is still in its infancy, there is no guarantee that it will remain viable over the long term. Additionally, it's important to ensure that the size of the market referencing term CORRA is appropriate relative to the size of the market that's used to determine it. I will point out that these use cases are broadly similar to the restrictions applicable to term SOFR in the US, with some nuances applicable to the Canadian market, and they also align with the majority of the responses that CAR received in its consultation on term CORRA that I referenced earlier. We have received quite a few questions around what constitutes a business loan in the use cases, and a Q&A will be published on CAR's website in due course to provide more clarity. What we'd ultimately guide people to do is conduct their own due diligence around whether there is a legitimate business or commercial purpose for a loan in order to respect the principles of limiting use cases to where it's absolutely needed. For clarity, loans that are made to individuals for personal, family, household, or related investment purposes would be viewed as consumer loans and are therefore not permitted to use term CORRA. If there are any questions regarding the use cases, you are encouraged to reach out to CAR, and there's contact information provided at the end of this presentation. The second thing I wanted to touch on briefly is how term CORRA will be used in the business loan market or the lending market. As Louise noted earlier, CDOR is the primary CAD reference rate that's used in the business loan market today. And our expectation is that this will be largely replaced by term CORRA. There's a few important things to point out as it relates to lending. One is to reinforce the importance of the November 1st deadline that Louise mentioned earlier as it relates to no new CDOR and the expectation on the part of OSFI that loans transition directly to CORRA after this date for new transactions or deals where there are material amendments. And there's more detail provided on CAR's website on what exactly constitutes a material amendment. Secondly, that bankers' acceptances, which currently underpin the CDOR rate, are expected to cease as a money market instrument post-transition. As a result, the mechanics around BA issuance and loan agreements, including the discounting concept, will need to be removed in conjunction with a transition to CORRA. Similar to LIBOR transition, CDOR currently includes an element of credit risk, and Louise touched on this earlier, which is different than CORRA, which is an overnight risk-free rate. As a result, a credit spread adjustment, or an addition to the spread, will need to be added to agreements if the goal is to make the two rates as economically comparable as possible. The other important point to highlight goes back to something I mentioned earlier, which is that there is no guarantee of the long-term viability of term CORRA as a reference rate. As a result, it's very important in the loan market to have fallback language in loan agreements to either overnight CORRA or prime should term CORRA cease to exist. Lastly, for borrowers that hedge their loans, it is anticipated that term CORRA-based derivatives may come at a premium to overnight CORRA given the respective depths of the two markets. As a result, the CAR recommended loan agreements do allow for the rate flip mechanism that was referred to earlier from term CORRA to overnight CORRA to help mitigate this risk. There is also the possibility that lenders may allow for the use of both rates in an agreement if that can be accommodated operationally. And we have seen a few deals that have had this concept in them in market already. For additional considerations related to the loan market, we would refer you to the TMX webcast series on loans, which is also linked at the start of this presentation. And with that, I'll turn it over to Gavin to provide an overview of term CORRA licensing and access. Gavin, over to you.
Thank you, Jacqueline, and good morning, everybody. I'll take us through licensing for term CORRA in a QA style format. The first question I have is, what use cases of term CORRA requires a license? So a license is required for financial lending institutions who want to use term CORRA as a reference rate for the approved commercial use cases. Or a license is required to access term CORRA for real-time T+0 same-day access for internal purposes. Inversely, a license is not required to use term CORRA on a delayed T+1 next day basis from the CanDeal Benchmark Services website. However, access to T+1 delayed term CORRA is for internal reference and valuation use only and is not approved for the commercial use cases. Second question is, what type of licenses are there? Term CORRA is provided as a global enterprise license for companies and its affiliates. License categories include financial lending institutions. For example, a large Canadian dealer may sign for term CORRA through their Canadian entity, but are at that point approved to use the rate globally across their enterprise for the approved commercial use cases. Another license category is market data vendors, and they may sign for a license to distribute term CORRA on a global basis to licensed companies. Interdealer brokers, clearing and trading platforms. These entities may sign for a license to provide the facilities required to support term CORRA products and services, for example, to be able to provide the interdealer swap markets. And corporate real-time licenses. For example, entities who don't create products but want to use term CORRA for internal or external valuations. Additional questions to cover off include, does a company with a term CORRA loan require a license? Companies that receive loans that use term CORRA as a reference rate do not need a license. Only the financial lending institution issuing the loan needs to be licensed. Does a company using term CORRA as an interest rate for project planning need a license? There's two possible answers to this question. The first is that a company does not require a license to use term CORRA as an interest rate for project planning, so long as the company is using delayed T+1 term CORRA published on a next day basis. However, if a company wants to use term CORRA as an interest rate for project planning purposes by accessing the rate in a real-time T+0 same-day frequency, they will need a corporate real-time license, which will only become fee liable in June 2024 on the formal cessation of CDOR. The next question is, do we require a license to participate as a lender in a lending syndicate? A lender who participates in a lending syndicate, either as a lead agent or otherwise, is required to have a term CORRA license. How do I access term CORRA? Term CORRA cannot be accessed directly from TMX over SFTP or web portal download, or from your preferred market data vendor. And who do you ask if you're not certain whether you or not you need a license? As noted on the screen, please contact TMX Datalinx at marketdata@tmx.com or visit the TMX Datalinx web store at www.tmxwebstore.com. With that, I'll pass it back to our host, Louise Brinkmann, for some final comments.
Thank you, Gavin. Now, if we've missed anything or you have questions, please contact us. And there's a guide right here that will help to direct your inquiry. So we have CanDeal Benchmark Solutions for anything to do with the calculation, the oversight committee, the benchmark website, general questions, complaints. TMX, you should contact for access questions, questions about market data vendors, licensing fees, and the price challenge function. And for use cases, we have an address here that you can use to contact the CAR working group and ask your questions about use cases, or if you have suggestions on use cases. These slides will be available on the TMX and CanDeal websites later today. So I know you're all very busy people, and I really, really appreciate your time today and your interest in term CORRA. And I just want to thank you for attending the webinar, and have a great day. Look forward to seeing you all again soon.